Today, I'm going to teach you how to do a discounted cash flow, or DCF for short. It's one of the most useful tools for figuring out what a company's stock is really worth. And don't worry, the DCF model I'll be teaching you is designed for everyday retail investors and even for beginners. We'll walk through a real valuation using a real company, McDonald's. So let's dive right in. For starters, a discounted cash flow, or DCF, is a method of figuring out what a company is worth based on the cash it's expected to make in the future. And in order to know how much cash the company is expected to make in the future, we're going to pull these numbers directly from the company's official financial report. The first step is to get the company's annual free cash flow. But what is the annual free cash flow? Annual free cash flow is the money a company has left over after it pays for its capital expenditures, which are the necessary long-term investments in things like equipment, buildings, or technology. In simple terms, this is the cash the company is free to use however it wants. For example, paying dividends, buying back stock, paying down debt, or reinvesting in growth. Now, for this particular DCF model, that annual free cash flow will be defined as the company's cash from operations subtracted by the company's capital expenditures, or CapEx for short. So to find those numbers, we're going to go to the company's annual report, also known as their 10K. And the way you access the company's report is by heading over to www.sec.gov/search filings. When you get to this page, you're going to enter the company's name into the search. And in our case, we're going to type McDonald's and click submit. Sometimes you'll see more than one option listed, as in our case here. But we know it's not McDonald's Ventures LLC, so we're going to click into the CIK, or Central Index key, for McDonald's Corporation. When you reach this page, you'll see all of the company filings. You can use the filter results, and for filing type, enter 10K. When you do that, you'll see all of the company's 10Ks, and in the case of McDonald's, all 10Ks going back to 1994 are publicly available. So let's open up the company's latest 10K, submitted February 25th, 2025. We'll click on the Interactive Data 10K, and then click on the gold 10K button on the left-hand side of the screen. And that brings us to the company's official annual report for the fiscal year ended December 31st, 2024. Okay, so once you open up the document, we'll look for the relevant numbers we need to calculate the company's annual free cash flow. To find the relevant numbers quickly, a useful piece of advice is, if you're on a PC, pressing Ctrl F will pull up the search bar within the 10K. On a Mac, this will be Command F. And in many cases, the cash the company generated from operations will usually be called something like cash provided by operations, or it could be cash provided by operating activities. If we just type cash provided by in the search, we can see that there are only 9 search results. The second search result gives us the exact number we need. It says that cash provided by operations was 9.4 billion, but this number is rounded. So let's see if we can find the exact number. And here it is. The 8th search result takes us to the company's statement of cash flows that lists McDonald's cash provided by operations at $9,447,000,000. Keep in mind the note below the statement of cash flows that state these numbers are listed in millions, meaning this applies to the first 3 digits, and the 4th digit represents the billions unit. Some companies will list their statement of cash flows in thousands, so you have to be careful and pay attention to that note. Okay, so now that we have this number, the next number we'll need is the capital expenditures. And we're going to do the same thing we did previously. We'll hit Ctrl F and type capital expenditures into the search bar. And here again, we have the company's rounded number of 2.8 billion in capital expenditures. We can see here that it was for the purpose of opening new restaurants and reinvesting in existing restaurants. This is helpful for when we're doing a full analysis of the company. But for now, let's just see if we can find the exact number for capital expenditures. And here, the 13th result takes us once again to the company's statement of cash flows that lists McDonald's capital expenditures listed underneath the company's investing activities of $2,775,000,000. Okay, so now that we have the company's cash provided by operations of $9,447,000,000, subtracting that by the company's capital expenditures of $2,775,000,000 yields an annual free cash flow of $6,672,000,000. And I just want to add this note, but if you type in free cash flow into the search bar, you can see this entry in McDonald's 10K defining the term free cash flow as cash provided by operations less capital expenditures. This is the same exact way we are defining free cash flow for our DCF model. And it also lists the company's free cash flow as $6.7 billion, which is just a rounded version of our number. Okay, so step 2 in our DCF model is getting the company's expected growth rate. In a future video where we cover a slightly more advanced DCF, I'll show you how to calculate the growth rate yourself by multiplying the company's retention ratio by the company's return on equity. But for the purpose of a simpler DCF model, there are two easier ways of estimating a company's growth. The first is by using historical trend analysis, where you look at how much a company's cash flow has grown year after year, say over the past 5 years, to get a sense of how fast it might grow in the future. But to keep this DCF model as beginner friendly as possible, we'll go with the second method, which is analyst forecasts. Most stock analysts provide a long-term growth rate or earnings growth forecast for a company. And while it's not ideal, it's often a useful proxy for future cash flow growth. For example, if you have a brokerage account with Charles Schwab Bank, you can access analyst reports like this one from LSEG Stock Reports Plus. Here, LSEG gives McDonald's a long-term 5-year growth rate of 7.5%. And this percentage is based on an average from 38 analysts and is the number LSEG uses when calculating the company's forward PEG, which is why I like to use LSEG's number. But if you don't have access to premium analyst reports, don't worry. Some websites provide similar estimates for free. For example, on Seeking Alpha, a website I write stock analysis for, the stock page for McDonald's shows a similar long-term expected EPS growth rate of 7.32% over the next 3 to 5 years. Now, keep in mind, this number is measuring expected earnings growth, not cash flow growth, and those two numbers aren't always the same. For example, just because someone earns $1,000 doesn't mean they actually keep $1,000 in cash. Still, these estimates can serve as a reasonable starting point for calculating future cash flow growth, especially in a beginner-friendly DCF like this one. Okay, so for our model, let's just use LSEG's long-term growth rate of 7.5%. The third step in our DCF is to take the company's annual free cash flow and multiply it by the company's expected growth rate over the next 5 years. Before that, let's label the years. Since the annual free cash flow number comes from the company's 10K financial report completed from the 2024 fiscal year, 2025 will serve as year 1 in our model. 2026 will serve as year 2, and so on up to year 5. So you can do this on a calculator, but multiplying the company's 2024 annual free cash flow of $6,672,000,000 by 7.5% gives us a result of $500,400,000. Now we'll add this growth back to our annual free cash flow, and we get an expected annual free cash flow for 2025 of $7,172,400,000. Now going forward, we're just going to round our results to keep them clean and easy to read, and just say that the expected annual free cash flow for 2025 is $7.17 billion. And we'll do the same thing for 2025. We'll multiply 7.17 by 7.5%, add the result back to the 7.17 billion, and get an expected annual free cash flow for 2026 of 7.71 billion. Now, I don't want to bore you with the math, but here are the rounded estimates for the next 3 years. Now, the fourth step in our DCF model is getting the discount rate. And here, I need to pause the DCF just for a minute to explain probably the most important concept when it comes to the discounted cash flow, which is a discount. There are 3 reasons for why $1 today is worth more than $1 in the future. First, people prefer consuming today to consuming in the future. Second, inflation decreases the purchasing power of cash over time, so $1 in the future will buy less than $1 would today. And third, there is risk in waiting for a promised dollar in the future because you might not get it. So for these 3 reasons I just gave, all future cash flows that we estimated when we multiplied by the company's long-term growth rate have to be discounted back to today's value using a rate that reflects the risk of investing in McDonald's stock. So the question is, how do we get that discount rate? Well, before I intimidate anyone with a complex formula, let's just get the numbers first. We'll only need 3. The first one is the risk-free rate, and this number represents the return you get for taking very little risk with your money. Also thought of as the return you can expect to receive if you hold on to a 10-year piece of US government debt to maturity. You can find this rate through a simple search typing US 10-year Treasury yield. And at the time I'm performing this DCF on June 28, 2025, we can see that the US 10-year Treasury yield is 4.279%, which we'll round to 4.28% and use as our risk-free rate. The next number we need is the expected market return. This is the return investors generally expect from investing in stocks. You can do an internet search and type stock market long-term average return, and we can see here that the average stock market return is about 10% per year. So we'll just go with 10%. Finally, the last number we'll need is the beta. The beta is a statistical tool used to quantify how volatile a stock is relative to the market. A beta of greater than 1 means that the stock is more volatile relative to the overall market. A beta of 1 means that the stock is as volatile as the rest of the market, while a beta of less than 1 means that the stock is less volatile than the overall market. For our beta, we'll use the company's 5-year beta, which you can find on Yahoo Finance by searching for MCD, which is McDonald's stock ticker. And when you click into the company page, you can find the company's beta calculated over a 5-year period of 0.56. We'll take this number as our beta. Okay, so now we have the 3 numbers that we need. So to get our discount rate, we're going to use the capital asset pricing model, also called CAPM, which states that the company's discount rate should be relative to the risk taken by investors and what return they could get from taking no risk. The formula is expressed as follows. CAPM discount rate equals the risk-free rate plus, open parentheses, the expected market return subtracted by the risk-free rate, close parentheses, multiplied by the stock's beta. Since we already have these numbers, let's just go ahead and plug them into our formula. And let's convert our percentages into decimals. So our risk-free rate is 0.0428 plus, open parentheses, 0.1 subtracted by the risk-free rate of 0.0428, close parentheses, multiplied by the beta of 0.56. Plugging these numbers into a scientific calculator will give us a result of 0.0748, which when multiplied by 100 gives us a discount rate of 7.48%. And when it comes to the discount rate, the higher the rate, the more perceived risk there is with the investment. Okay, so let's move on to step 5 in our DCF, which is getting the company's residual value, or how much the company is expected to earn in perpetuity over its lifetime. Because after all, we only calculated McDonald's cash flows over the next 5 years, but we need to know how much cash the company is going to generate over its lifetime. And you can think of this like buying a rental property. You're not just looking at the price tag, you're looking at how much income the property will bring each year. The more cash it generates, the more valuable it is. And we're applying that same analogy to a stock. we're not just looking at the stock price, we're looking at how much cash the company will generate each year to gauge how valuable the company really is. So how do we get the company's residual value? Well, just like we did with the discount rate, before I give you the formula, let's just get the numbers first. We'll only need 3, and we already have 2. The cash flow in year 5 of 9.58 billion, our discount rate of 7.48%, and finally, we need a terminal growth rate. Okay, so what is a terminal growth rate? Well, remember what we did previously. We took LSEG's 5-year long-term growth rate and applied it to McDonald's cash flows over the next 5 years. Well, the logic is the same for a terminal growth rate. We're going to apply a longer term growth rate to McDonald's cash flows over its lifetime, and this is what's called the terminal growth rate. When choosing a terminal growth rate, the most important principle to remember is it should never exceed the risk-free rate. Remember that the risk-free rate represents the long-term return on something ultra-safe, like US government bonds. And if you assume a company will grow faster than that forever, you're basically saying that it will eventually become bigger than the economy itself. And every company, no matter how great it is, will eventually mature and decline. That's just a natural business cycle. So how do we choose the right terminal growth rate? Well, since this rate reflects how a mature company will grow forever after year 5, it should be conservative, usually somewhere between 2 to 3%, because that's roughly in line with expected long-term inflation and economic growth. And in general, the more bearish I am about a company in the long term, the lower my growth rate. And likewise, the more bullish I am about a company in the long term, the higher my growth rate. This is why it's important to at least be somewhat familiar with a company before choosing a terminal growth rate. That way your DCF inputs will be more accurate, and therefore your final valuation will be more accurate. Since I'm more bullish than I am bearish about McDonald's in the long term, I'll assign the company a terminal growth rate of 3%. One last point. Some of you might be wondering if it's ever okay to use a 1% or a 4% terminal growth rate. The answer is yes, but there are some caveats. First, a 1% growth rate would be appropriate for a company in decline or facing major headwinds. For example, a shrinking market or outdated products. This could be a company in a mature, low-growth region or industry with little innovation. Or you're just being intentionally conservative to add a margin of safety to your valuation. And a 4% terminal growth rate is usually reserved for young growth companies that are still expanding rapidly, because a 4% growth rate implies that a company can outpace inflation and GDP growth for longer than average, but not forever. Since this DCF is designed for stable, mature companies with more predictive cash flows, such as McDonald's, it makes more sense to stick to a terminal growth rate between 2 to 3%. And again, we'll go with 3% for this model. Okay, so now that we have all the numbers we need, let's look at the formula for acquiring a company's residual value. The residual value equals, open parentheses, the cash flow in year 5 multiplied by, open parentheses, 1 plus the terminal growth rate, close parentheses, divided by, open parentheses, the discount rate, subtracted by the terminal growth rate, close parentheses. Okay, so now let's plug our numbers into the residual value formula. So we have our open parentheses, our cash flow in year 5 of 9.58 multiplied by, open parentheses, 1 plus our terminal growth rate in decimal format, close parentheses, divided by, open parentheses, our discount rate in decimal format, subtracted by the terminal growth rate, close parentheses. Plugging these numbers into a scientific calculator gives us a residual value of $220.25 billion. Now we have all the cash flows from years 1 to 5 and the company's residual value. Moving on to step 6 in our DCF, we're going to recall the principle that we learned in step 4, that $1 today is worth more than $1 in the future. So step 6 is discounting all these future cash flows to their present value using the present value formula. The present value formula is the following. The present value equals the future value divided by, open parentheses, 1 plus the discount rate, close parentheses, raised to the power of the number of years into the future. Sounds complex, but it's really not. Let's start with year 1. The future value is 7.17. So we're going to take this number and divide it by, open parentheses, 1 plus our discount rate in decimal format, close parentheses, raised to the power of 1 because this is year 1. Plugging this into a scientific calculator yields a value of a rounded $6.67 billion. So this is our present value for year 1. And we'll do the same thing for year 2. The future value is 7.71. Let's divide this by the same equation, except this time we'll raise to the power of 2 because this is year 2. And interestingly enough, we get the same value of 6.67 billion for year 2. Finally, we'll calculate the present value of each and every future cash flow with the results shown here. Okay, so to get the present value of the company's $220.25 billion residual value, we're going to plug the numbers into our formula again, and we're going to raise to the power of 5 because the residual value is considered to be in year 5. And this gives us a present value of a rounded $153.56 billion. Okay, now finally we made it to the last and easiest step of calculating the company's intrinsic value per share. First, we're going to add up all of our present values. This gives us a total of $186.94 billion. This is what we'll call the company's intrinsic value. To get the intrinsic value per share, we have to divide the intrinsic value by the number of outstanding shares. To get this number, we'll head back to the company's filings and look at their latest financial report, which could be the 10K, i.e. the annual report, or most likely their 10Q, i.e. the quarterly report. As we see for McDonald's, their latest financial report was their 10Q, released on May 12th. So we're going to go into their 10Q for the period ended March 31st, 2025. And as we see at the bottom of the first page, McDonald's outstanding shares of common stock total 715,032,727. Now we simply divide the company's intrinsic value of 186.94 billion by this number of outstanding shares to arrive at an intrinsic value per share of $261.44. Now, as of the making of this video, McDonald's shares are currently trading at $291.55. And to see how much the shares are overvalued by, it's an easy formula. You just subtract the current share price of $291.55 by the intrinsic value per share of $261.44 to get $30.11. Now, if you take this result and divide it by the company's intrinsic value per share of $261.44, you get 0.11516. And multiplying that by 100 gives us a rounded 11.52%. In other words, McDonald's shares are overvalued by roughly 11.52% above their intrinsic value. And that's it. That's how you do a basic, beginner-friendly, discounted cash flow. If you received value from this video, please hit the like button and leave a comment below. And of course, I'll see you in the next one.